So today we'll be starting with sources of short-term and long-term finance. See, whenever we are talking about finance, first of all is considered as the lifeblood of any business. Because whenever we are talking about business means you cannot do anything without having finance. No matter your business might require less amount of finance, or some other business may require a more amount of finance, but ultimately every business is in need of finance, right? And whenever we talk about this finance, do remember that you always need adequate amount of finance so that a proper and a smooth functioning of the business can be conducted. But whenever we are talking about that adequate amount of finance, the question arises, how much is that adequate amount? See, first of all, in this case, the promoters of the company, that means the people who actually start the company, who actually conceive the idea of starting the business, they need to calculate the financial need of the business, and that can be done with the help of a financial plan, right? So in that case, it is considered that financial management plays a very important role. That means you need to consider your sources as well as your applications of funds, because whenever we are talking about finance, this finance is going to affect your profitability, the growth, and the survival of your business. So ultimately we can say, if there is no finance, we cannot conduct any business. So no finance means no business, right? Because finance will help you in serving the purpose of business, right? Now the question is, for what all purposes do we need finance? We need finance for raising, providing, and managing all the things in the business, because you need to raise resources, and for raising those resources you need funds. So first of all, you need to raise funds. Then whatever funds you raise, you need to provide them to different resources, like maybe to different departments, or maybe to different assets, like what all assets need to be purchased and how much funds are to be provided. And also you need to manage the finance, you need to manage the funds, because you need to manage the day-to-day operations of the business, right? So ultimately we can say that finance is required for conducting each and every activity of the business. But if we talk about the modern day scenario, in case of modern day scenario, the overall funds required in the business are divided into fixed and working capital, because they say that there are two different types of funds that are required for different types of purposes, right? That is the fixed capital and the working capital. So broadly, we can say that whenever we are talking about the finance, we are talking about the actual amount of money that is required for conducting the business activities, right? So now, whenever we are talking about the business finance, there are certain features associated with it. That is, first of all, it is going to deal with the financial aspect of the business. And when we are talking about business finance, that means we are concerned with estimating how much funds are required, then collecting the required funds, and then finally utilizing those funds for appropriate purposes. And for that matter, we need to have a proper planning and control with respect to your financial resources. Right? But do remember that whenever you are doing such an activity, it should be result oriented, or you can say objective oriented activity, because you randomly cannot plan your funds, right? Whenever you are planning, so that means you have some result in your mind. So we consider this as the major aspect of your business management, and it is dynamic in nature. When I use the term dynamic, that means I'm talking about that it is not that once I have planned and I can continue with it as it is. No, you might require certain changes. So you need to review it again and again. And based on your review, there might be certain changes required as per the changing conditions. So as a result, we say it is dynamic in nature. And as I told you, that every business requires different types of finance, that is fixed and working capital finance. Fixed capital for capital related transactions. Say, for example, you want to buy a building, you want to buy assets and all. And working capital is required for your day-to-day operations. And also remember that you cannot just rely upon one particular source of finance. You need to have different sources of finance from which you can raise funds depending upon your requirement and the availability. Now, the question arises, what exactly is the role of business finance in your organization, or rather, I should say, in any organization? See, first of all, whenever we are talking about business finance, this business finance is going to affect your profitability, your survival, and the growth of your business. And whenever you just think of starting the organization, then you need to have finance even at that point of time. So we can say even to promote the organization, your funds are required. It's not that once your business has been settled, then you require the funds. No, you require the funds at every step, or you can say at every stage of your organization. That means starting from the promotion stage, right? Then it also ensures orderly functioning of an organization, because to run your organization in a systematic manner, you require funds for day-to-day operations. As a result, we can say this finance is considered as the backbone of every business. Also, we can say that finance brings stability to the enterprise. Why? Because if you do not have finance, you'll not be able to manage your operations. And if you're not able to manage your operations, then your business will not be running in a stable manner, right? And if your business is not stable, then certainly your business operations will be hampered. That means there will be no stability, no smoothness in your business. Then you also need funds for your expansion, modernization, and diversification. Because what if you want to expand, if you want to diversify, or if you want to modernize, for each and everything, funds are required. You cannot just expand without the funds. So for each and everything, adequate amount of funds are required as and when there is a requirement. Also, this finance is going to support your other functions of business. Because if I'm talking about the, say for example, if I'm talking about the functions of management, if I say I need to plan, then in that case, I need people who can actually plan. And when I need people, that means I need to pay them off also. And to pay them off, I need the required amount of funds. Similarly, if I talk about organizing, organizing requires that, you know, you need to arrange the different resources. And if I need to arrange the different resources, I need to buy the required resources, maybe in the form of machinery, technology, or whatever it may be. So as a result, again, that requires funds, right? So for each and every funds are required. Then these funds will help you in meeting your objective of wealth maximization. Because if you have the required amount of funds, then only you will be able to survive in the market. And when you will be able to survive, then you will be earning profits. If you will be earning profits, then only you will be able to increase the amount of the quantum of your profits in the organization. And if your profits keeps on increasing, then ultimately you will be able to achieve your target of wealth maximization. Because any organization which is not performing well will never achieve the wealth maximization. So ultimately, for any type of problem, for any type of thing related to your business, you require funds. Now, whenever we are talking about the business finance, there are certain principles related to our business finance, in which the principle is full utilization of funds. See, your funds should not be lying idle. Reason being, because whatever funds you are using, or whatever funds you are having in your business, you are arranging in your business, they are not free of cost. Everything comes with a cost attached. So similarly, your funds also, when you raise your funds, say for example, you take a bank loan. So that bank loan is not free of cost, right? Because whenever you are talking about a bank loan, then certainly there is a cost attached to it in the form of interest, repayment of principal as well as interest. So in that case, when you know there is a cost attached to it, and if those funds are lying idle, that means you're not able to earn a sufficient amount of return on that. So as a result of which, it will ultimately increase your cost component, because you have to pay your interest. It's not that if you're not earning profits, so you're not supposed to pay the interest. Certainly you have to pay the interest, and the payment of that interest is ultimately increasing your losses, you can say, indirectly. Reason being because you are not earning anything out of it, right? So as a result, it is very much required that you should have full utilization of the funds. Secondly, you should have maximization of return on investment. See, there might be a possibility that you are utilizing your funds and you are earning a return on that, say for example, at the rate of 8%. But the loan that you have taken for these funds, the interest on that loan is to be paid at the rate of 10%. So even then, in that case, you are maximum return, and the funds are actually adding to your cost because the return is at 8%, whereas the cost you have to pay is at the rate of 10%. So accordingly, you need to take the decision. Third, prosperity. Member funds are required for the overall survival and prosperity. That means profitability and expansion of the business. Without funds, we cannot think of such things. Then next is fair balance between liquidity and profitability. Whenever you are utilizing the funds, whenever you are reaching funds, do remember that just having profitability is not sufficient. At the same time, you should also have liquidity associated with it. When I use the term liquidity, that means how quickly you can convert it into cash. If suppose you are earning good amount of profits, but there is no cash availability in your hand and your debts are becoming due, your debts are becoming due, you are not having sufficient amount of cash, so you are not in a position to repay your debt. So as a result, such finance is not good because it is giving you profit, but it is not giving you availability of cash. So you should plan your business finance in such a way that there should be a balance between profitability and liquidity. And your business finance should be such that it enhances public image. You should not fall into the trap of, this organization always keeps on adding to the borrowed funds. They're not in a position to repay it. So whatever funds you are raising, make sure that it enhances Am I audible?
Yes, ma'am.
Okay. So as I told you that as per the modern concept, the financial needs of the business are categorized into two categories, that is fixed capital requirement and working capital requirement. When I use the term fixed capital requirement, it means I'm talking about the capital that is required for buying the fixed assets. That means for capital transactions, right? Capital nature transactions. And your working capital requirement is the amount that is required for running the day-to-day operations of the business, which is denoted by the term working. Right? There are certain factors that you need to consider while choosing from which you can raise the funds. That is the cost. If suppose, I'm taking a loan from a bank has a particular amount of interest or at the rate of 12%, and I can get another type of loan and pay only 8%. So that cost component is to be considered because ultimately that cost is to be paid also. Secondly, you also need to consider the risk profile because whenever you are raising the funds, there is certain amount of risk associated with it. And that risk could be, related to the maybe the control of the organization or maybe the charge on the assets of the company. So depending upon accordingly, you will have to take the decision. Thirdly, you also need to consider the purpose and time period, because what, say for example, I need funds for next 6 months and I raise the funds for next 5 years. So there is no use, because I'll be using these funds only for the upcoming 6 months, and for remaining 4.5 years, I'll be just adding to my cost. So I need to consider the purpose as well as the time period. Then I also need to consider the tax benefits, because whenever I am talking about the debt obligations, the borrowed funds, they give me tax advantage in the sense that the interest payable on debt borrowing is tax deductible. So as a result, it reduces the taxable income, right? Then also, whatever funds you are raising, it should have flexibility and ease. I mean, it should be easy for you to raise those funds. It should not have a very lengthy and cumbersome process. And at the same time, they should be flexible enough that you can make the changes according to changing requirements and according to the changing time period, right? Then whatever funds you want to raise, make sure that they will increase the they will enhance the financial strength of the operations. Because if the funds that you are raising is ultimately not adding to your financial strength, or they are further weakening your financial position, then there is no use in it. And also form of business organization you are into and your legal status. Because if I'm talking about more sole proprietorship, then I cannot expect that I can raise the funds for my Okay, so when I'm talking about partnership firm, I cannot expect that I can raise finance through issue of shares, because issuing the shares is possible only in case of a company, right? And lastly, whatever funds you are raising, you know that they are going to affect your credit worthiness. So do remember, whatever is your requirement and whatever source you are choosing, it should enhance your credit worthiness. It should not deteriorate your credit worthiness, because once your credit worthiness goes down in the market, then you will not be able to raise finance in the market. No one would like to deal with your organization, and ultimately it becomes difficult for the organization to survive, right? Now, whenever we are talking about the sources of funds are categorized into three, based on three parameters. First is the periodic basis, that means based on the time period, where your time period is divided into short term, which is a period of less than 1 year, then medium term, that means between 1 and 5 years, and long term, that means a time period of more than 5 years. The second parameter is ownership basis, where you have owners funds and borrowed funds. And the third parameter is sources of generation of funds, that is internal sources and external sources. So you can see that these are the overall categorization based on which you can raise funds, right? So on the basis of period, you can see we have long term, medium term, and short term. Similarly, on the basis of ownership, you have owners funds and borrowed funds, and on the basis of source of generation, you have internal and external funds. We'll be doing all of them one by one, but do remember that all these categorization, they are not mutually exclusive, they are mutually inclusive. That means one category falls into the other one. So let's start with the various sources of capital. The various sources of capital are retained. I mean, the list is given to you over here. We'll be starting each one of them. Starting with the first one, that is retained earnings. See, retained earnings basically means this is the amount of profit that the organization is earning, but this profit is not being distributed among the shareholders or among the owners. That means a part of that profit is retained in the business. That means it is kept in the business for future use. That means we can say a part of the profit is reinvested in the business, or it is kept as a reserve for a particular purpose that is known as retained earnings. The second one is trade credit. See, trade credit means when you buy the material on credit from your supplier. So say, for example, you get a credit of 3 months. So that 3 months, when you get the material and you don't have to make the payment, so it again becomes a kind of a short-term loan, right? And usually the business transactions, they are conducted based on trade credit only. And this is also a type of a source of fund. Next is your factoring. Factoring basically means when you sell your material on credit to your customers, right? So you have your accounts receivable and you know that you are going to get this money, say for example, after 2 months or 3 months. So in that case, what you can do is you can sell your trade receivables to a third party who's known as a factoring agent, right? So that means the factoring agent will be paying you the amount today after charging a certain percentage of the commission, and on the maturity, whatever will be the amount, then that amount will be paid to the factoring agent. Next is your lease financing. Lease financing is basically used for medium and long-term financing. And in this case, it's just kind of a rent type of a thing, right? That means whosoever is the owner of the asset, that owner is giving the right to another person, that means the tenant, that he can use the asset. And in exchange of the usage of the asset, that person or that organization will give them periodical payments in the form of rent. That is known as lease rent. The person who is the owner of the asset is known as the lessor, and the person who will be using the asset is known as the lessee. Then you have public deposits. Public deposits means it is a kind of a short-term, you can say it can be short-term or medium-term unsecured deposits, which the companies, they invite from the general public. And the basic purpose of inviting this is to consider the working capital requirements of the company, right? So if the company is interested in such type of public deposits, they usually give an advertisement in the newspaper regarding it, right? And whatever the people invest, they get a deposit receipt in return, and that deposit receipt is a kind of an acknowledgement of debt which is given by the company, and in which all the terms and conditions of the deposit are written, right? Even the rate of interest is also rate of interest as well as the period of deposit is also mentioned. Next is your commercial paper. Commercial paper is a type of a short-term and unsecured money market instrument. See, do remember, money market means we are talking about short-term, and capital market means we are talking about long-term, right? So it is an unsecured money market instrument, and it is issued in the form of a promissory note. Commercial papers are usually issued by big corporations. That means I'm talking about blue chip companies which have excellent credit ratings, because these are unsecured, so everybody will not be interested in investing them. If only your company has a good, very good credit rating, then people will like to invest in it, because in that case the risk level assumed is less. Then you have issue of shares. See, as far as your shares are concerned, there are two types of shares: equity shares and preference shares. Starting with the first one, that is equity shares. Equity shareholders are the true owners of the company, and it is considered as the main source of finance for any organization. These shares are issued to the general public, and do remember that these equity shareholders, they do not enjoy any preferential right, right? They do not enjoy any preferential right means that they will not be getting priority in the payment of dividend and in the final repayment. But yes, they are the people, they are the owners who will get the residual income of the company. That means if the company is earning exceptionally high amount of profits, so they will be enjoying those high amount of profits. And they also enjoy the control of the organization, because they are the owners of the company. So they have voting rights in the matters related to the overall management of the company. Whereas the preference shares are the ones who are also known as the shareholders, but they are not the true owners of the organization, and they are the ones who enjoy the preferential right. That means they will be paid the dividend first, that means before the equity shareholders. After paying off to the preference shareholders, if anything is left out, then it is to be paid to the equity shareholders, right? Similarly, in the event of final repayment, first payment is made to the preference shareholders, and then whatever is left out is to be paid to the equity shareholders. But also at the same time, these preference shareholders, they do not have any voting rights, because they are not the true owners of the company. Now the question arises, what is the exact difference between the two? The difference between the two we have already discussed, but a few more points are there. Like when we are talking about preference shareholders, they usually get their dividend at a fixed rate, whereas equity shares, in case of equity shares, the dividend is declared every year, depending upon whether the company has earned more or less in the given year, right? Secondly, with respect to the areas of dividend, in case of preference shareholders, they can get their cumulative preference dividend if in case in particular year the company was not able to pay it. But in case of equity shareholders, they do not get any past dividends. As far as voting rights are concerned, we have already done that. Then payment of dividend also. Now the last point, that is related to convertibility. Preference shares may be convertible into equity shares, but equity shareholders are certainly the true owners, so they cannot be converted into any other class of shares. Next is your debentures. In case of debentures, it is again a type of a debt instrument, and it is not secured by physical asset or collateral. See, for debentures, there can be different options. It might be secured, it might not be secured. Both the options are there. But yes, they are usually backed only by the credit worthiness and the reputation of the company. This is a very common type of source of finance, which is frequently used by the governments and the organization. And similar type of instruments which are used by organizations are bonds, which are somewhat similar to debentures. I'll not say exactly similar, but yes, they have some features in common. Now, whenever any particular organization, they are requiring funds, so they can go for these debentures as an option. They can offer these debentures to the general public and call for their subscription, just the way they do it for equity shares. But do remember, debentures are issued under the common seal of the company, and it acknowledges the receipt of money. Then you can also go for your commercial banks. That means when you can get a proper loan from them, right? And when you get a loan, then certainly it has to be secured in the sense you need to keep some mortgage, or you need to keep some security, and a particular rate of interest is to be paid on that. Apart from your commercial banks, you can also go for financial institutions. Financial institutions, they also deal in loans similar to the commercial banks, with the only difference that financial institutions, they also provide loans for very long term, and at the same time, when they provide loans, they also provide certain other facilities and other assistance to the organizations as and when they require with respect to their projects. Then there are certain international sources of finance also, like you can go for commercial banks, you can go for international agencies and development banks. Then there can be foreign direct investment, or you can even have you can even have access to the international capital market in the form of global depository receipts, that is GDRs, American depository receipts, ADRs, and FCCBs, that is foreign currency convertible bonds, right? So if I start with the first one, that is your international agencies and development banks, you have different types of agencies in this. Like you have IFC, that is International finance corporations, then you have your Exim Bank, that is Export Import Bank, and you even have your ADB, that is Asian Development Bank, which can give you finance for international trade and business. Then you might go for foreign direct investment. That means where you have direct subscription to the equity share capital of an Indian company by a foreign company, right? Then you can have your GDRs. In case of GDRs, we are talking about that when an Indian company is raising foreign currency and it is traded on a foreign stock market, right? And when we are talking about this foreign stock market, that means we are talking about European stock exchanges. Then you can go for ADRs. ADRs is similar to your GDRs with the only difference that they are traded in America, right? The stock exchanges of America, right? And in case of ADRs and GDRs, do remember they are commonly used by the Indian companies so that they can raise funds from the foreign markets, that is the capital markets, right? So with this, we come to the end of this. Any doubt in this particular chapter?
No, ma'am.
Ma'am, I want to ask you something.
Yeah, but, you can.
Ma'am, PDFs from we are studying, can we get those PDFs?
Okay, shall I forward those PPTs in the WhatsApp group?
Group, ma'am, yes.
Okay,
Yes,
fine. I'll
ma'am,
do that.
I needed.
Yeah, no issues. I'll do that. Don't worry.
Okay, ma'am, thank you.
Most welcome. Now, moving on to the last chapter, that is corporate restructuring management. See, first of all, whenever we are talking about corporate restructuring, we can compare it to a medical surgery. Now, the question arises, how can we compare it to a medical surgery? See, in case of a medical surgery, what do we do is that we are trying to treat for a particular ailment, right? So similarly, in case of corporate restructuring, we say it is a process where we are trying to treat an ailing company based on the professional diagnosis, depending upon what kind of problem is existing in that particular company, right? So as a result, we are trying to bring that company out of that particular ailment or that particular problem, right? So we can say that we are talking about fundamental change in the company's business, or you can say the financial structure or the assets or even the ownership of the company, right? So it is basically a comprehensive process. It is not just a small change that you are bringing in your company. It is a comprehensive process in which the company can consolidate its business operations, and it can even strengthen its position for achieving its short-term and long-term corporate objectives. So whenever we are talking about this corporate restructuring, that means we are talking about a change in the ownership or maybe the business mix or something. So we can have different type of restructuring, and that restructuring could be ownership restructuring, business restructuring, or assets restructuring. Right. Now, the question arises, does this restructuring create any value for the organization? See, the basic principle behind going for corporate restructuring is to create shareholder value, which is over and above that of the sum of the parts. Because if you have an individual structure, then that individual structure will not be having that much value, which this corporate restructuring will bring. Right? But this corporate restructuring will create value only if the combined entity that you will be forming after the restructure, the overall value of the combined structure is greater than the sum of the value of individual companies. So if I'm talking about that, there are two companies, A and B, and they are getting themselves restructured. So A plus B, the value, the combined value, which I've denoted by C, should be greater than the individual value of A plus B, right? And or if not greater, then at least equal to, right? But if I'm talking about the value destruction, then in that case, the value of C will be less than or equal to A plus B. So in general, we consider that the value of C should be greater as far as the combined value of A and B is concerned. Now, the question arises that what exactly is the purpose of this corporate restructuring? See, it is done when we want to expand the business operations of the company, or when we want to carry on the business more economically or more efficiently, and also we want to focus on the core strength of the company, that is cost reduction, by deriving the benefits of economies of scale. Because when we are talking about the overall, just a minute. Okay. Now we also at times we get into a corporate restructure to get certain tax advantages, because many times when you merge together, so a loss of making the company, I mean, if you know that, I mean, individually you are suffering losses, so there might be a possibility that combinedly you will be converted into a profit-making organization. And at times you do go for restructuring so that you can have access to better technology, and you can also have access to better market share, because when you combine your resources, then certainly you are at a upper hand. I mean, you are at a better position as compared to your individual position. Then at times you can also overcome your significant problems. Say, for example, you have a problem of technology, or maybe you have a problem of space, or maybe you have a problem of staff. So everything can be taken care of, and you also get global competitive advantage. Now, when we are talking about this corporate restructuring, we have different techniques or strategies related to it. That means we have expansion techniques, then we have divestment techniques, and we have other techniques. Starting with the expansion techniques. For expansion, we have merger or amalgamation, acquisition, takeover, strategic alliances, and joint ventures. Starting with the first one, that is what is amalgamation. See, whenever I'm talking about the term amalgamation, that means I'm talking about when one or more companies, they join together to form a new entity. So that means at least you have two or more than two, right? They join together to form a new company. And when we have joined together, so the new company that comes into existence is distinct from the merger. Why? Because when we are talking about amalgamation, then neither of the previous companies are into existence. Whereas in case of merger, one company retains its original position and the other one merges into it. But in case of amalgamation, both the companies, they lose their actual identity and they form a new one, right? So you can just have a look at the example given. See, we have company A and we had company B. So both the companies, they are known as the amalgamating companies. So they formed, they join hands, they get into an amalgamation, and they form a new company known as AB, right? Now, whenever we are talking about these mergers and amalgamations, there are basically 4 different types of mergers, right? We have horizontal mergers, vertical mergers, generic mergers, and conglomerates mergers. Starting with the merger. See, in case of merger, what happens is we have one company that is A and another company that is B. A is the acquiring company and B is the acquired company. So when this merger happens, then the acquiring company A will merge company B into it. So that means B will no more be into existence. It will be only A, right? Now there is another possibility known as merger through absorption. When we use the term merger through absorption, in this case, there's a combination of 2 or more companies into an existing companies. That means all the other companies except the one is going to are going to lose their identity, right? Say for example, like in case of Tata Fertilizer Limited, which was merged by the Tata Chemicals Limited. So that means Tata Fertilizer Limited was is no more into existence. Now it is Tata Chemicals Limited. Now next is your merger through consolidation. Now when we use the term merger through consolidation, it means the consolidation, or you can say it is a combination of two or more companies into a new company. So that means in this case, all the companies, they are dissolved and a new company is created. That means in this case, even the acquired company will transfer its assets, liabilities, and shares to a new company for cash and exchange of shares. In this case, I've taken the example of the amalgamation of Hindustan Computers Limited and Hindustan Instruments Limited. Next is your acquisition. Acquisition, in case of acquisition, or what we call as takeover, in this case, it does not necessarily entails full or legal control. A company can effectively control over the another company by holding minority ownership. So it's not a complete takeover kind of a thing. In this case, there might be a possibility that some portion or maybe some section of the other company is, you can say, you're taking the ownership of that so that you can actually control the operations of the company. Next is your takeover. In case of takeover, the acquiring firm takes over the control of the targeted firm. And in this case, we have two types of takeovers, that is friendly takeovers and hostile takeovers. In case of friendly takeovers, what happens is when it is mutual, that means out of friendly terms, and you know that you're not able to manage, you ask one of your friendly associates to do the needful. So for your, just as a helping hand, they will go for a takeover so that you can manage your business operations. But in case of hostile takeover, it is, you can say, a forcefully takeover where maybe the acquired company is not liking the situation, but the acquiring company is forcefully taking over the acquired company. Next is your strategic alliance. In case of strategic alliance, it is an arrangement between two companies to undertake a mutually beneficial project. That means each one of them, they have their own identity, but for a particular kind of a project, they are coming together, right? So in this case, the agreement that they come into, that they form is less complex and less binding than a joint venture. Because in case of joint venture, you even pool your business resources to create a separate business entity. But in this case, you're not creating any separate business entity, right? Next is your joint venture. Joint venture means when two companies, they join together for a particular time period. And it is a contractual agreement. Like, for example, you must have heard about Hero Honda. Hero Motocorp and Honda Motors, they had two different entities. They were two different entities, but they joined hands to form Hero Honda for a time period of 5 years, right? And after 5 years, they are again separated, because when Honda Motors, they wanted to enter the Indian market, especially for the two-wheeler segment, they were a Japanese company which were not aware about the Indian scenario. So they wanted someone from the local markets. And for that, they had Hero Motocorp, and they joined together to form a joint venture. Now, next is your divestment techniques. For divestments, you have demergers, under which you have three different sub-techniques, that is spin-off, split off, and split up and split off. Then you have leverage buyout, sell-off, and liquidation. Starting with the spin-off. See, a spin-off will occur when a subsidiary will become an independent entity, because they are, you can say there is disinvestment, or they are getting separate, right? So that means the parent company will distribute the shares of that particular subsidiary to its shareholders through a stock dividend. So because this transaction is dividend distribution, so in this case, the subsidiary will become a separate legal entity and will have its different management and board. Next is split up. Split up means where you will transfer all or substantially a major part of the assets, liabilities, loans, and businesses of the company to 2 or more companies. Right. So again, it will be like a spin-off in which the shares in each of the new companies are allotted to original shareholders of the company on proportionate basis. But in this case, spin-off transferor company ceases to exist. Right. Next is your split-off. Split-off is again a spin-off with the difference that in case of split off, all the shareholders of the transferor company, they do not get shares in the transferee company in the same proportion in which they held shares in the transferor company, right? Next is your leverage buyout, which is known as LBO. In this case, the acquisition of another company using a significant amount of borrowed money. Borrowed money could be in the form of loan or bonds to meet the cost of acquisition. See, normally what happens is the assets of the company being acquired are used as collateral for the loans, because when you are taking the loan, then certainly some security is to be kept. So that security or that collateral is in the form of assets, right? So apart from the actual security that has been kept, the assets of the company can be used. Then you have sell-offs. In case of sell-offs, which is also known as divestiture, it is an outright sale of the company's subsidiary. Usually this type of option is done because the subsidiary doesn't fit into the parent company's core strategy, because it is not a part of your core competency. So you want to, split it off. You can, and for that split off, what you do is you go for outright sell off, right? Now there are certain other techniques, like you have reverse mergers, equity carve out, going private, and share repurchase. Starting with the first one, that is reverse merger. Reverse merger, which we call it as reverse takeover or reverse merger, or you can say reverse merger takeover, which is also known as reverse IPO. It is an acquisition of the public company by a private company, so that the private company can bypass the lengthy and complex process of going public, right? So they want to have the benefit of getting into an easy process. Next is the equity carve-outs. In case of equity carve-outs, the parent company, makes a subsidiary through, you can say, makes a subsidiary public through an IPO, right? Which will amount to a partial sell-off. So a new publicly listed company will be created, but the parent company is going to keep a controlling stake in the newly formed subsidiary also. Next is going private. Going private is when a public company wants to get converted into a private, and that is done through repurchase of stock by the current management or outside the private investors, right? And in this case, the most common transaction is paying the shareholders cash and merging the company to a shell corporation, which is owned by private investors and management group. So it is actually treated as an asset sale rather than a merger. Then next is your exchange ratio in mergers and acquisition. See, the exchange ratio is the ratio which will measure the ratio of shares of the acquiring company is offering the target firm. for 1 share of the target firm. So because ultimately, whenever you are doing this, it's not that freely you can go for mergers and acquisitions. There has to be some form of financial transaction that is to be shown. So we can simply say that we can calculate the exchange ratio in accordance to the merger or acquisition agreement. So you can just have a look at the example, which will bring you more clarity. Say there are two companies, company A and B, and company A will acquire company with shares of common stock. Present earnings of company A is 2 crores and company B is 50 lakhs. Now the shares outstanding of company A is 50 lakhs and for company B it is 20 lakhs. And the earnings per share is earning divided by the number of shares outstanding. That comes out to 4 rupees for company A and 2.50 for company B. The price per share is 64 per share for company A and 35 for company B. And the price earning ratio is 16 for company A and 12 for company B. Right now, when I'm talking about this price earning ratio, you can simply see now. Let's see how to move ahead. Now see, company B has agreed on an offer of rupees 35 in common stock of company A. So now the surviving company is your company A, and the total earnings is 2 lakh 50, sorry, 2 crore 50 lakhs. That will be A plus B, because in previous slide you can see it was 2 crores and here it was 50 lakhs. So combined will be 2 crore 50 lakhs. Now the shares outstanding. Now with respect to your shares outstanding, you need to consider your exchange ratio, right? Your exchange ratio is 35, that is the agreed offer rate, upon 64, that is the price per share of company A, right? So your exchange ratio to this. So the new shares from exchange will be this exchange ratio into 2 crores. That is the earning, the surviving company, that is company A. So your overall new shares from exchange comes out to this much, right? So in this example, we can conclude that the shareholders of the company A will experience an increase in earnings per share of acquisition, that is 4.10 post-merger earnings per share, whereas it was 4 the pre-merger stage, right? So the shareholders of company B will experience because this features is section 2 to 240 that covers provisions, right? And then Okay, so apart from the legal processes, we also have a planning process in mergers and acquisition. That is the pre-acquisition management. These are, I mean, this I have given it in the form of a flowchart so that it becomes easy for you to remember. That is intent, information, value, price, and approach. Similarly, for post-acquisition, approach, people, culture, organization, and strategy. And for post-acquisition performance, it is accounting, profit, stock returns, market share, operating efficiency, and cash flow. Starting with the pre-merger and acquisition intent, that means we are talking about the motive or the objective the purchase of a competitor or a business. Then, for that matter, you need to consider a wide variety of facts and information which is necessary to maintain and reinforce a purchasing decision, which is known as information. Then you need to consider the worth of an acquisition deal. Because if it is not worth, then you will not buy it, you will not go for it. So you need to consider the value, and with respect to that value, you need to consider the price, because if it doesn't suit your price objective, then you cannot go for it. Then you also need to see the approach that you will have to follow, because there are a variety of procedures that to persuade the target firm so that you can finalize an intended acquisition deal. So you need to see what particular approach you will be following. Now, post merger and acquisition, you have your approach. That means again, you have a variety of procedures so that you can reconcile a predetermined acquisition intent to the target firm. Then you have a people, because there will be a group of people of the merging companies, right, who have either a positive or a negative perception towards this acquisition deal. Then you need to consider the culture. Culture means the basic assumptions like the norms, the value, the policies that the members of the organization share in common. Then you also need to consider the organizational. That means we are talking about the organizational configuration, which will include your formal and informal structures, the systems, and the processes. Then you also need to consider the strategy. That means I'm talking about the set of consistent alignments effort so that you can achieve your long-term goals of the merging company based upon the acquisition intent. Then you also need to consider the post-acquisition performance evaluation. That means I'm talking about the accounting profits, because in that case, you need to consider your return on equity, return on investment, your profit margin. That means we are talking about the financial performance of the organization. Then you also need to consider your market returns, because you also have to see that what impact it will bring on the concerned organization. Also need to consider your market share. That means we are talking about the sales revenue, whether they are increasing or what will be the overall impact. Then you also need to study the operating efficiency. Operating efficiency means we are talking about the value added gains, because now you have merged resources. So based on that, what kind of efficiency you will have. And then the cash flows, because you need to see the overall cash flows, the overall sales, cost of goods sold, the expenses, what impact they will have. And you also need to consider the performance evaluation criteria. That means the overall cash flows, your operating cash flows, means the day-to-day activities like your sales, your cost of goods sold, your selling and administrative expenses. Then you need to also consider your cash flow with respect to your free cash flow per share. What exactly will be the in-hand amount of cash flow? Then you also need to consider your market share. That means your market share gains or losses, right? And lastly, you also need to consider your stock returns, because ultimately with the changes in the overall structure, there will be changes in the market price of shares also. So whether you are getting a positive return or a negative return. This I have just given a case study kind of a thing. That is the Fortis journey. So just for your reference, you can go through it. So with this, we come to the end of your entire syllabus. Anyone, any doubt?
No, ma'am.